Okay, hello and welcome to Chapter 1 Notes. So in this chapter we're going to talk about some basics of management accounting, compare financial accounting against managerial accounting, and then do a few problems where we talk about variable costs versus fixed costs and their behavior, and like I said, apply it to a few problems. Okay, so let's go ahead and start. So here I'm going to talk about financial accounting versus managerial accounting in terms of the purpose and the definition, and then here I'll talk about comparing and contrasting those two along a couple different dimensions. So in financial accounting, as you know, we are looking to provide external users with general purpose financial statements. That's the point of financial accounting. So those financial statements, the statement of cash flows, the balance sheet, the income statement, for example. Some examples of external users that we talked about up here would be considered investors, creditors, government agencies. On the other hand, with managerial accounting, which is the focus of this course, is more concerned with provide internal users with relevant information for decision making. You can't read my chicken scratch there. It says provide internal users with relevant information for decision making. So now we can come over here and we can compare financial accounting to managerial accounting across a couple different dimensions. So here we can say with users, we're talking more about external. Again, investors, shareholders, regulators, for example, creditors. With managerial accounting, we're talking more internal. So internal managers. I used to work as a management accountant quite a bit for electronic data systems, Ross Perot's company that he started, and I was, like I said, as a financial analyst, which is kind of a term that falls, or a job code that falls under the umbrella term management accountant, and we provided internal reports to different division managers, program managers, project managers on the income statement for their division, for example. Okay. Generally accepted accounting principles of financial accounting, it must comply. Okay. So our general purpose financial statements, the income statement, balance sheet, so on and so forth, need to be prepared in accordance with GAAP. Okay. Management accounting, managerial accounting is not governed by GAAP. Okay. On the other hand, not governed by GAAP. Okay. It can be optional to follow GAAP, and that's because it's used internally. Okay. The focus of the information presented in financial accounting tends to be more summarized at the company level. Over here, we're talking more detail. Maybe we're looking at a segment or a department. Okay, at this level for management accounting. Non-monetary information in terms of financial accounting is not going to be emphasized. Right? This is over here with managerial accounting, can be more emphasized. An example would be would be customer satisfaction. That's an example of non-monetary information. Wouldn't find that in financial accounting. Wouldn't find that in the income statement, for example, but it might be something that we look at over here with reference to managerial accounting, especially if we're doing something with the balanced scorecard. When we talk about the time focus here, we're saying we report past performance. And of course over here with management accounting, it's going to be more future oriented. So again, if we go back to that customer satisfaction measure example, customer satisfaction would be a leading indicator of performance. You know, if we report net operating income after the fact, well, that's a lagging indicator of performance. We're reporting what happened. If we say these were sales for the fourth quarter, we're reporting a lagging indicator. We're reporting what happened. But with more of a future-oriented indicator, it would be something like customer satisfaction. With the thought if customer satisfaction is good, that bodes well for sales in the future, and vice versa. If it's not good, well, that does not bode well for sales in the future. Okay. So now what we can do is we can talk a little bit about planning and control and budgets within management accounting over here. I'm sure that you've had some experience with this in your prior courses or in your professional experience. So we look over here. I'm just going to go through this kind of quickly. Planning, we can say, is the process of setting goals and making plans to achieve those goals. Okay? And then over here, with our budget, I just consider the budget a financial plan, right? And then we look over here with our control, we can say it's the process of monitoring planning decisions, right? And evaluating company activities and employees, right? So we think about this little diagram that we have over here. We set up a plan, okay, maybe a budget. We'd set up a budget, a financial plan, and then we would take actions to implement the plan, put in the appropriate staffing resources, for example, and then we would look at results. And so this is something that I used to do quite a bit as a financial analyst. We had our budget, and we would compare actual results to plan results, compare actual results to budget. So actual revenue to budget revenue, actual cost to budgeted cost, actual profit to budgeted profit, and that would be our evaluation. And then, of course, if the manager in charge hit their budgeted profit number, they could receive a bonus. If not, they may not receive a bonus. And if this keeps going on, we may actually have to revise our plan, rethink our budget, or perhaps we need a new manager. Okay? So we talk about performance. This is kind of falls under this comparison of planned and actual results and evaluation. That's an example of performance, right? Performance reports, that's one way that we would do this, is through performance reports. So performance reports are a way to achieve, control, and evaluate performance. So compare actual to budget. Okay? So we look on the next page right over here. We have an example performance report. So we can look at this. We look over here. We can see, look at the cost of bottles, and we can see that actual is higher than budget, and this would be an unfavorable variance. Okay? And then ingredients cost is higher than budget. That's an unfavorable variance. Look over here. Labor actual $295, budget $300,000. That's going to be a favorable variance. Okay? I would rather put a U, or a U meaning unfavorable, F meaning favorable, and state these in absolute value rather than positive, negative, because I find that to be confusing. Okay. One of the things that we'll talk about later on during the course as well is the importance of making sure that our production and our budgeted and our actual production are the same, because there are some costs here, such as the cost of bottles, the ingredients cost, the water, and then the labor. These are all variable costs. And these costs we would expect to be different if we made more bottles of soda. Okay? So for example, if we make more bottles of soda, then the cost of bottles is going to go up simply because we made more bottles of soda. Same thing with ingredients, same thing with labor. Rent, depreciation, and we don't know about other, but we'll talk about rent, depreciation for sure. These would be considered more fixed costs, and so they would stay the same regardless of our production level. So it doesn't really make too much of a difference here to make sure that these are the same when we're considering fixed costs, but it makes a big difference when we're considering labor, variable costs, such as labor. Okay? All right, so continuing on, we'll talk about some cost terms here, such as variable costs versus fixed costs. We'll say over here with our variable costs, they are costs that increase or decrease in total with the level of activity. Okay? With the level of activity, so it would be example, would be our direct materials. Okay? Or we could also say our direct labor. Or we could also say commissions, for example. Okay? The other thing about variable costs, so that's the first characteristic. The second characteristic is that they stay constant per unit, say constant per unit, say the same on average. Let's say on average, okay? So an example of variable cost would be waiter and waitress salaries in a restaurant. So for example, if it's a busy night, we would expect that total compensation for waiters and waitresses would be higher than if it's a slow night, simply because we had more hours, right? People are working more, it's a busy night, we have to bring in more people, so we're going to pay more hours. But that does not change how much we pay our waiters and waitresses per hour. We still pay them the same per hour, but we have higher total direct labor cost simply because we are paying more hours. So that variable cost would increase or decrease in total with the number of customers, but it would stay the same because the number of hours would go up, but it would stay the same per hour. Still stays $5, $6 per hour, or whatever we pay. Okay? But because the number of hours goes up, our total compensation cost will also go up. Fixed costs, on the other hand, typically stay the same or constant in total, decrease per unit as activity increases. Okay? So that's two things about fixed costs. That's the first thing. Stays constant in total. The decreases per unit as activity increases. Example would be depreciation, rent, advertising. And so let's look at rent on a restaurant. Go back to the restaurant example. If we have 100 customers, if we have one customer, we still pay the same amount of rent. We still pay the same amount of rent on a monthly basis, regardless of how many customers that we have. So rent is a fixed cost. It stays the same in total, regardless of the level of activity. But if I wanted to say I had $100 of rent per month, and over this 1 month I just had 100 customers, my rent per customer is 1. But if I come over here and I had $100 of rent, right, and I only had 1 customer in the month, well, what happens is that I have my rent per customer is $100. So as I move from 1 customer to 100 customers, that fixed cost of rent is spread out over more customers, and therefore it decreases per unit per customer as the number of customers increases. Okay? So let me talk about direct cost versus indirect cost. So a direct cost, as we'll see on the next page, can be easily traced to the cost object. A direct cost can be easily traced to the cost object. Indirect cost, on the other hand, cannot be easily traced to the cost object. Okay? And on the next lecture video, I will go over those in more detail. Thank you.